Good morning, everyone. I, Dr. Purnima Madan, on behalf of Lloyd Business School, welcome our eminent speaker, Mr. Shemsher B Singh, all the faculty colleagues, the students who have joined the webinar. Lloyd constantly strives to build knowledge for its young managers by bringing astute leaders and faculty to augment their learning. In order to embrace the future managers with the latest developments in the corporate world, Lloyd has taken the initiative to conduct the Expert Talk series based on the theme Enhancing Employability Skills for Budding Managers. Today, we are having the 11th Expert Talk on how to invest. Without much ado, I would like to introduce our eminent speaker. We are honored to have with us Mr. Shemsher B Singh. Sir has done his engineering from IIT Roorkee and was a gold medalist. He is an MBA in Information Technology from New York. Mr. Singh has worked with manufacturing sectors for a couple of years, has worked with IT sector at Infosys for 8 years, that too across different locations like USA, New York, San Jose, California, etc. Sir has also worked with pharma sector for 8 years. Mr. Singh has 18 years of experience in equity market along as a long-term investor and full-time investor in equity market and derivatives market trader with small portion of capital. He has been constantly involved as a chief speaker, part-time trainer, taking sessions on equity market and derivatives at various institutes across Delhi NCR. Sir is the founder of a capital market institute called Y Equity. I welcome you, sir, and would now hand over the session to you. Thank you.
Good morning, everyone. So let's begin with the session. Topic for the session today is how to invest. That's what I've been asked to speak on. So I hope everyone is able to see the slides.
Yes, sir, it's visible. The students can please post if they are not able to see the slides in the chat box. So it's visible to everyone.
Okay, so that's great. So let's begin. So the very first question comes to our mind, when we talk about investing is like, why should we invest? The question is, why should we invest? So the answer to this question is, historically, India is not a very financially literate country, though we are academically doing good, but when it comes to financial literacy, we are lagging behind. So the point here is the objective. Why should we invest? The first thing is like achieving our financial goals. The goal could be short-term goal, or goal could be long-term goal. But to achieve our financial goal, we need to invest the money. The second reason why should we invest is to generate a parallel stream of income, create wealth, and earn a return to beat the inflation. The point here is the average inflation in India is 4, 5, 6%. So 6% inflation. So if our return is not more than 6%, technically speaking, our money is not growing. So the investment is like, it should beat inflation for sure. Then only it is actually going when it comes to purchasing power. And the third point you can say is that a comfortable life even after retirement when your regular income stops. So these are the main reasons. There are many more. We should invest. There are different products in the market, when it comes to investing, like traditional products like bank fixed deposits. We have products like Public Provident Fund, PPF, NPS, National Pension Scheme. People do invest in real estate. I'm from stock market, so I have bias towards equity market or stock market. So I always suggest stock market. There are other investment options as well, like commodities when it comes like gold, silver, and stuff like that, and others like debenture, bonds, and stuff like that. So these are the by and large the asset class or the financial products for the investment. Which investment product should we pick? This is a very common question. Like, there are so many products, which one should I pick? So the answer to that question is, each financial products are made for to achieve a certain target, certain reason. So none of the product we can say is bad, or none of the product we can say is extremely good. Depending on the situation and requirement, each product is designed accordingly. So FD is also good, stocks is also good, real estate is also good, depending on like what is your requirement at that particular of time. Second thing is like historically equity, yeah, stocks. Stocks equity is like a synonyms kind of thing. So equity and stocks, they have given best return or best performance over all asset class over a longer period of time. Hence, I advocate investing in stock market. Moreover, it is important to understand that every asset class has a risk associated with it. Even no one can say that FTs are 101% or 100% secure. Once your money moves from saving account to any asset class, there is risk get associated with that money. So we need to understand that investing is risky. And as I told earlier, like I'm an equity guy, I'm a stock guy, so I always prefer equity over any other asset class or any other financial product like real estate, gold, silver, or any other product. So how to start? Like let's say we understand why we need to invest, and we also understand what are the products in the market where we can invest. Then like how to start investing. So this is like everyone is get stuck here only because they do not cross this hurdle, like how to start. So there are 3-4 basic rules based on the historical data experience of the people. These are made, and as of now it is working kind of okay with those who are following this framework. So first thing is like, before investing, we need to understand that we need to take care of this surprise situation, awkward situation, or is the situation which we don't have control, so that our investment journey, our investment process does not get hampered. For example, before investing, we need to have contingency fund, or liquid fund. Let's say I'm a working professional. So 6 months of my salary, let's say I'm earning 50,000 per month. My expenses are 50,000 per month. So approximately 6 months of salary, like 3 lakhs rupees, should be in my bank account, either in the form of short-term fixed deposit or in the savings account itself. The objective of this fund is, just in case I get sick for longer time, or I lose my job due to some reason, like the situations like COVID and all. In those situations, I'll be having a 6 months corpus to to navigate or to sail my time, so that for that I don't have to touch my investment. This fund will be used for those kind of things where I am not able to work for for some time, or I lose my job. For that, we need to have contingency fund. The first thing is, a contingency fund equivalent to 6 months of monthly expense needs to be kept as a short-term FD or in the bank account. Second thing is, if we don't do this step, we need to touch our investments. For example, in COVID time, if we don't have this contingency fund, we are having investment in stocks, we are going to sell our stocks, and the market was extremely down at that time. So what will happen? We will lose on both sides. We will be selling our share at a very, very cheaper price. So the contingency fund is required. That is for sure. Second thing is insurance. See what happened, no matter how much money you earn and save, but at times in life, let's say medical insurance, like someone gets admitted, our loved one gets admitted in the hospital, and the bills are going up and up. So it will suck all our savings or investments. So for that, we need to have the health insurance in place. And earning member in the family, let's say those who all are earning, either mother, father, sister, brother, who all are earning, they should be having life insurance, kind of term insurance, what we call nowadays, in place, so that contingency fund and insurance, these will take care of my rainy days in my life, and my investment will be growing uninterrupted. Coming to next point, like how much to save. So there is no fixed formula, but historically what our parents have taught us or what we have learned, that saving is like, whatever we are earning, and after all the expenses, whatever is left is the saving. This is the formula what we have learned. Earning minus all the expenses, so it's saving. But financial discipline says something else. It says the formula needs to be changed. We need to have, like we pay equally monthly installment, very similar to that from our income. Saving has to be kept aside at the beginning, and it should not be the leftover, and expenses should be managed with the leftover. For example, and saving should be around 20% at least for a, whatever is the earning. 20% of the income should be saved. So my point is, let's say someone is earning 50,000 per month. So 20% is like, 10,000. So 10,000 every month has to be invested. Income 50,000, 10,000, 20% is has to be saved, invested, and rest we can, expense for our daily needs, our need, our want. So point is, like EMI, a fixed amount, which should not be less than 20% of our income, should be invested every month. And like EMI, we have SIP. EMI is equally monthly installment when we pay the loans. SIP is systematic investment plan. Like every month we invest some portion of money to the, let's say equity market or any asset class. Equity, a long-term wealth creator. See, very few people make money in equity market. Owner of Zerodha, Mr. Kamath, last year he made a statement in public domain that only 5% of the people make more than fixed deposit return in the stock market. I repeat, as for Zerodha owner, Mr. Nikhil Kamath, only 5% of the people make money more than fixed deposit return. And since he is having the access to all his, clients' data, he can, his data is, his statement is data validated. So only 5% people are making money, that too around 6% and above. So the simple reason is that, equity market required a lot of knowledge, a lot of experience. Then only the money really can be made in the stock market. So the point here is, here, when we say knowledge and experience, is just not like, I have read this book or I'm following this. So it's knowledge we earn over a period of time. It's not like just, going through few books or going through attending few sessions. It's not like that. This knowledge has to be earned over a period of time. Hence, many people say money cannot be made by borrowed knowledge, not in investing, but across, a segment. So if you are directly investing in stock market, you learn it with professionals, or with slow and steady manner, you learn it. Otherwise, you invest through mutual fund or portfolio management service. There are most of the broking house, they have their, mutual funds or portfolio management. Both the things are there. You go with that. But my point is, do not invest in stock market directly without knowledge and experience. If you are going to do it, chances are very heavy that sooner or later we are going to lose the money. So this is very important. This is the point where most of the people make mistakes. When Nikhil Kamath says that 95% of people lose money, 5% of people make more money than FD return. The simple reason is most of the people are not knowledgeable, not experienced enough to understand the equity market or stock market, and they invest directly. Mutual fund and PMS, portfolio management services, they do it for us. They are skilled, knowledgeable people, and they understand the market. They know the cyclicality of market. They know the volatility of market. So they will sail our money through the rough time as and when required. So my point is, invest through mutual fund or PMS, or if you want to directly invest in equity market, then learn it. Next point is, investing, once Warren Buffett says, is eighth wonder of the world, because power of compounding, it really works here. At example, I'll say a 10 lakh invested a lump sum in one go for 40 years in stock market directly at the rate of 18% return, it will become 100 crore. I repeat, 10 lakhs, 40-year, 18% return, and it will become 100 crore. Means your 10 lakhs will become double 10 times in 40 years, because there is a rule called 72 rule. With that rule, 18% return will land up making your money double every 4 years. And this is very much doable. It's not like it's a theoretical data or it cannot be done. The only point is, do we have patience, do we have knowledge, do we have experience to sail this 40-year journey, to get our investment, let's say from 10 lakhs to 100 crore over a period of 40 years, just by merely 18% return, which is okay in stock market when someone is investing directly. So this is the about equity market investment. Next is there are many rules and discipline which we need to follow when we invest in equity market. The first one is SIP is one of the better way of investing, at it absorb market volatility and average out ups and downs. So what happens, SIP means systematic investment plan. So what exactly it means that let's say market is low at some times, and you are investing let's say 10,000 rupees every month. So your investment will go when the market is low. Let's say COVID time, the market was low. You will invest at that time also. And let's say right now the market is relatively high, so you will invest in that time. So things will be average out over a period of time, and at the same time, you will not get emotionally carried away. You know that every month I need to invest at least 20% of my saving. You'll keep deploying those money, every month, irrespective of market is going up, market is going down. Because behaviorally, behavior is and discipline is the only way to win in the market. If we try to time the market, nahi abhi niche hai, we should buy more, or abhi upar hai, we should sell, then it is a puzzle no one has yet solved. We will be trapped. So the best way is follow a discipline, follow a rule, that is SIP, invest a fixed sum of amount every month, and every year grow that. Let's say my salary is 50,000, I am investing 10,000 every month. Next year my salary becomes 60,000, then I'll start investing 12,000 per month, and so on. So my point is, SIP is the better way of investing. It is absorb market volatility, and it offset our behavioral, bias which might create over by market. Market, this is mostly, always is, most of the time it is right, or I should say it's always right. But at times it is illogical and irrational. For example, COVID time, the market was, COVID, or even before COVID, we had, in 2008, we have a Lehman Brothers crisis, a real estate crisis, or we call it subprime crisis. In 2000, we had the dot-com problem. So every decade, we have some or the other big problem, and the market goes down. So what happens, when market goes down, it behaves in such a way that the world is going to end. Like in the COVID times, it was within 1 month, market was like 50% down. And thing was like the world is going to end. So the point here is, if we are not behaviorally strong, we will get trapped. We will sell our stock that, no, the world is going to end and let us sell our stock. So the point here is, market is at times irrational, because it fell so much during COVID time. So we need to understand and take out those irrationality, that when it goes up like anything, it goes down. So we need to accept it the way it is. It is irrational, illogical at times, but mostly it is right. One more thing is, market is there to take our money. It is not to reward us. It rewards only the investor who are disciplined, behaviorally organized, knowledgeable, experienced. Initially, luck can work for some people in one or two investment, but if one is not knowledgeable, not experienced, he or she is going to lose money for sure. Intelligence doesn't play a bigger role here. There is a use case about Newton, the famous scientist Newton, which has given 3 rules. He lost big money in the stock market while his friend made a lot of money in the stock market in 16th, 17th century. In a shipping company, both invested money. The reason is Newton was applying intelligence and his friend was a disciplined and behaviorally strong guy. He did not apply. He was more of discipline. He made money. Newton lost his all saving in that shipping company in 16th, 17th century. So the point here is discipline and behavior wins, knowledge, experience wins. Intelligence has very less role. You can intelligence. When I say intelligence, means timing the market, that it is high now, we need to sell. It is low, we need to buy. These types of things will always be trap us and we will lose money. Next point is as we know that market is there to take our money unless we defined a framework like how to invest. Like one of the rule of the framework is, like as I told, invest in SIP mode. When I say SIP mode, means every month fixed income, fixed saving needs to be deployed in the stock market. So this is one of the framework. If you're going to mutual fund or PMS, if you're doing it, well and good. There are those who invest in equity market directly, they have their own. Everyone who is making money, they have their own framework which suits to their style. This is also important. The product or the investment suits to individual style. Some people like thrill, some people are okay with not thrill, but they are more in like making money. So the investment should suits to their style. So kindly select the mutual fund accordingly, or if you're investing in stock, make your portfolio accordingly. In our what we do, we buy fundamentally strong stocks, which is staying strong balance sheet, a robust business and product services, which has some USP which cannot be copied or recreated. This is easy to say, but there are parameters when we those who really wants to learn it. There is something called return on capital employed. This is one parameter fundamentally which we check when we invest in when we say fundamentally good company. There is something called debt equity ratio, means a company should have minimum debt or no debt. That is considered relatively good company to invest. Company should have a consistent growth, history in the past, 10, 15 years. Like it should be consistently growing 15% every year. Profit should go every 15% every year. And the product and services should be, I should be like, I'll give you example, like, let's say, there is a product, product called baby milk powder product, Nan and all these comes. There is I'm just naming the company. It's not a recommendation to invest. A company called Nestle manufacture this product. It has a 97% of market share, and since it's a replacement of baby milk powder, government doesn't issue new license to these any new company. It comes, no one can advertise. Rules are such that no one can advertise that product on TV. So my point is, baby milk powder product, which is produced by Nestle, is placed in such a way that fresh license is almost impossible to get, and at the same time, if someone gets it, no one can have ad on TV. We don't see milk powder ad on TV. So the point is, the product is, with word to mouth advertisement has captured 97% market and very difficult to replace this Nan brand. So the Nestle company is a fundamentally strong company to my understanding. Again, it's not a recommendation, but just for a data sharing point, I'm telling that this is one of the companies. There are many more such companies, where you need to understand that is the product services can be recreated. If the answer is very difficult to create, and if the company is doing, we are using the product or services, company is doing good, then we should go ahead and invest in those companies. See, whenever we do investing, our investment could land up in four scenarios. Either it should land up with a small profit, or it should get converted into big profit, or it should get to a small loss, or it can get into big loss. For example, I bought a share, it rose 10%, it's a small profit. It went down 10%, it's a small loss. The stock went double or triple, it's a big profit. And the stock got 50%, it's a big loss. So we are not investing in one stock. We are creating a portfolio of, let's say, 15 stocks. So my point is, we are betting on portfolio, not individual stocks. Our portfolio should give 18% return over a period of year, 18% CAGR over a period of time. So big losses we should avoid. Either we should book the loss or whatever the action we should take, but it should not be like we are holding a stock and it is sitting on a 50% loss. So my point is, every investment will end up in 4 use cases. The 4th use case, big loss, we should avoid. It is okay to book loss, but it should not be it is not a good idea to carrying a loss-making trade for a long time. Next point is, most profits is made not by brilliant entries, but by sitting on profitable position for long enough. So if you got a winner, let's say you bought a stock and you are sitting on a decent profit, the best way to make big money in that, just sit tight on that stock, and over a period of time, things will fall in place and you will make big money in that stock. And most people make mistake, as I told, like they enter in the market without knowledge and experience. Similarly, people buy stock with the tip, like someone's relative told, someone's friend told, someone's told, like something of that. Do not follow tip, do not follow news. It doesn't work. This is a chart, I have used in one session in one of the school in Ghaziabad. It's little old, but the message here is, see, it's not like, I'm taking best case scenario. There are many examples, I'm taking one. The point here, this is Infosys chart from 1993 when the company IPO came till 2015. 9,500 invested in the IPO. 100 share, 95 rupees, 23 years. I'm taking data till 2015 only. It turns to be 5.3 crore. I repeat, 9,500 invested in equity market in 1993. For 23 years, it is turned up to be 5.3 crore. There are many such stories of such kind in stock market. Our objective is not to find such 10 stories. If we find at least 1 or 2, it is good enough for our 18% target. I entered in this stock in 2003-4 when I joined Infosys. I got 3 stocks. So I invested in this stock for a long time, and I made money in this, good money in this stock market, holding it for a long time. So that's why I'm sharing this stock with you. Many people do, they let's say they buy some share at 100 rupees and the share comes down 80, they buy more. When it comes 60, they buy more. This doesn't work. Most of the time, this doesn't work in stock market unless you are, you are fundamentally so much aware of this stock, or you are really expert of the stock. Point here is, do not average your, positions in loss. If a share is going down, do not buy and try to bring down average buy price down. That mostly that doesn't work. Second thing is, never over invest. My means only surplus money which you are saving, from your income that needs to be invested. A borrowed money or a loan money, or those money should not be deployed in the stock market. The money which you don't need for next 3 to 5 years at least, that should go in the stock market. It's not like apna contingency fund, that fund we deploy in the stock market, or borrowed from parents or borrowed from friends and deployed in the stock market, or took loan from bank and stock market. That's not advisable. That's not workable, because here time is our friend. We are betting more on time rather than making quick money. And there is something called derivatives, future and option we call it. Avoid those products unless you are really understand that. There is those products can wipe out your capital in a single day. I know many people in the stock market, they have lost crores of rupees which they earned over a period of 10 year, 20 year, 30 year, and they lost in one day in single trade, just because of they were trading in derivatives. So my point is, this is like playing with fire. So even though if you understand, I do derivative trading, but only 10% of my capital, that is it. So that if I lose, I'd lose only 10% of my capital. And that too, I have opened separate account with separate broker with that 10% capital. So point is, avoid derivatives. And as I told, we don't need 10, 20, 30 winner stock. We just need 1 or 2 stocks winner, and that is enough for our lifetime. For example, the great Warren Buffett, he had one big, winner Coke. He bought it in very early and hold it till today, and that stock has, given rewarded him, lifetime. Same with our Mr. late Rakesh Jhunjhunwala. He had Titan in his portfolio at a lower price, and it holded it for a very long time, and that made him really created wealth because of that. So the point here is, we don't need 10 winners. 1 or 2 will be enough for us to make money in the long term. And that's pretty much from investing, how to invest. Now I can take questions for 10 minutes as scheduled.
Sure, sir. Thank you so much. Yes, we have got a lot of questions for you to answer. The first is from Anurag, and he says, investment in liquid fund is good.
Yeah, investment in liquid fund is good, provided, see, if you are expecting a reasonable return just above fixed deposit, or just beating the inflation, then it's good. It will not create wealth for you, that is for sure. So point is, contingency fund, you can invest in liquid fund.
Okay, sir, we have another question, and it's by Anurag, and he says, please suggest the best way to study stock market.
See, the best way to study stock market is invest some capital in some good stocks. Some capital, let's say I have 20,000 rupees. I bought 5 stocks worth 4,000, 4,000, 4,000, and keep starting. It's more like, back-ended, and keep studying those stocks. Start monitoring the stock and get adjusting with the price movement of the stock. So the best ways to learn is invest a small amount of money. The market will teach you, you will start following itself. So the best way is start investing, and then you will learn it. It's like swimming, swimming by dipping into the water. It's not like learning swimming in notebook.
Yes, sir, we have 3 related questions to what you have just answered by Shaista, Sonali, and one more person, Alisha, and all of them says that what is the best platform to learn about stocks market? We are the one says that I have a lot of interest in equity market, but I end up losing many times. So how to learn about market?
See, the thing is, the best way is, like, as I told, like, one is invest some amount. The other way is, like, take some professional sessions with, professionals, those guys, how should it? The Professor Sanjay Baxi, he was in MDI Gurgaon. He is considered guru of fundamental when it comes to India. So he's the one person we can follow him, or if we get a chance to attend his session. So my point is, there are 3, 4, or maybe at the most 6, 8. Really, those people are not available on TV or social media. They are available very, very selective way. So my point is, try to attend some professional courses with them. Like I attended a couple of courses going to Bangalore and here and there, and try to implement those learning what you learned from them.
So there is a question by Shubham Kumar, and he says, how to interpret options data in Nifty, and how is PCR is relevant in option chain?
See, this is a trading question. So we are talking about investing. So I'm not in favor of trading. So my point is, rather I'll skip this question. If he really wants to know the answer, I can answer it offline. It's a trading question. It's a derivative question. I don't recommend to get into that. And those data can be fooled. It can be give wrong signals. No one has till time really figure out what exactly that means, because there are market participants, those who create those data, PCR data or Nifty options data. So if I want to show you that the PCR data is showing a bull trend, I'll create a position in such a way that it will look like it's a bull trend, but actually it's not a bull trend. So point here is, it's a trading question, and I do not advocate trading.
So there is I think 2 more questions from Shubham. The second question says, is NASDAQ and DOJ Jones correlated to Indian markets?
The word market is kind of not correlated. It's kind of follow the US market. US market is a leader, and the rest of the world follows that market. So if US market is going up, probability is that rest of the world will go up. If the US market is going down, probabilities rest of the more will down. But this is not rule. Stock market, there is no rule as such.
There is one more question, sir, from Shubham, and he says, should we focus on technical skills, a technical analysis, or in fundamental analysis if we are thinking in the investment banks or venture capital jobs?
See, it is good to learn multiple skills. Like if you know fundamental analysis, technical analysis is good. My answer is that technical analysis is more used in trading and all. So if you have that skill, it's okay. But fundamental analysis is very much required, because where there you really know that what is the company, which product is manufactured, and what is the competition in the market. So my point is, fundamental analysis is the key. Technical analysis is more of a trading to, and if it's good to good to know. It's not like you need to know technical analysis only, then only you can make money. Fundamental analysis is key. Warren Buffett is fundamental analyst. Rakesh Jhunjhunwala is fundamental. Those who are really made big money, they are fundamentally analyze the stock rather than technical analysis.
So there is one more question, which is by Govind, and he says, which is better, SIP or mutual fund?
We do SIP in mutual fund. Mutual fund is it's a platform where we invest the money. SIP means it's like every month we are investing in that. So my point is, investing SIP way in mutual fund is a good way of investing.
There is a question by Alisha, and she says, why it is recommended to invest most in blue chip companies?
See, the reason why it is because they have a proven track record. They have survived multiple economic down cycle. So probability is that they can survive the coming down cycle in the market as well. Like we had one down cycle in COVID times. So the point here is, they have stronger fundamentals and proven, proven track record. Hence, it is recommended to invest in blue chip companies. But any company can go bankrupt overnight. We need to keep in mind. If Lehman Brothers can go bankrupt overnight, or Satyam can go bankrupt overnight, or DHFL can go overnight, any company can go. That's why we invest in 15 companies. So even though if one company goes bankrupt by any reason, we should be safeguarded with the rest of the 14.
Sir, if you permit, can we take 2 more questions?
Yeah, sure. Go ahead.
All right. There is a question from Ajay Gupta, and he says, difference between stock market and SIP.
See, stock market or equity market is like, where we, buy share and sell share. SIP is like, systematic investment. It's like, EMI, it get debited from our account. SIP is like, we invest every month from that account. So not correlated, but exactly. Stock market is a platform to where we invest. SIP is like, it's a term. It's nothing, but it's like, investing 10,000 every month is called SIP.
So there's one more question, and it says how to invest money in mutual funds.
So, like ICICI, HDFC, all the big banks, they have their, mutual fund branch. So we can go there and we can open the account, we can open SIP, and they, so my point is, you need to have a bank account, and with that bank, you need to go there with their, investment department, and they will do the needful. Like, they will say like how much you want to invest and which kind of fund you want to invest. Accordingly, you select the fund and get started.
So the last question, how does investing affect my taxes?
Yeah, so I just missed this point in my slides. Investment should be tax efficient as well. FD, fixed deposit, is not tax efficient because it is taxable. So investing is very tax efficient. The reason is, no matter how much profit I am making, the tax will not be applicable unless I sell the stock. So if, let's say, I bought a stock at 100 rupees and it will become 1,000, and my portfolio has gone 10 times, I am not liable to pay a single rupees unless I sell a stock. So that is number one. Number two, 1 lakh profit is exempted. Every year, 1 lakh profit is exempted from the equity tax. Third is, the tax is lowest. If you have investment for more than 1 year, the tax is only 10%. Let's say I made a profit of 1 lakh this year, and I sold my stocks. So 1 lakh is already, I don't have to pay any tax. But if I made a profit of 2 lakhs, by selling the stocks, 1 lakh is exempted, and for another 1 lakh, I need to pay only 10,000. So my point is, equity investing is tax efficient because the tax is, long-term tax is 10%, and 1 lakh tax that's exempted.
Thank you so much, sir. I would, I hope that today's expert talk on how to invest will help all the students to learn to be more wiser in investing their money for a better return. I would like to thank, on behalf of Lloyd Business School, Mr. Shemsher B Singh, sir, for taking out time from his busy schedule and guiding the students. Thank you, sir. And thank you, everyone, for joining the session. We will see you soon in another interesting session. Thank you so much, sir, for giving out your time and sharing your wisdom with us.
You're very welcome, ma'am. You're very welcome. Thank you, everyone.
Thank you, sir. Thank you. We are concluding the session, everyone. Thank you for attending.